Chapter 17 is financial statement analysis that kind of brings everything together that we've learned up to date. So there are your learning objectives. And what we're going to break these different financial ratios into different categories. So we've got, liquidity, solvency, and profitability. There's also market ratios that could be done to determine what's going on in the financial markets. So liquidity is looking at what do creditors think of this company? So really what that's measuring is, do they have the ability to pay those short-term bills as they come due? If they don't, obviously that's going to be a problem. They're probably going to go out of business quickly. So creditors and investors look at those liquidity ratios to see how the company is doing. Solvency are going to be more of those long-term creditors. Like, am I going to give them a major loan through the bank? If I'm a bond investor, would I consider them a good investment? So that's more long-term focus. Are they able to pay the large amount of debt that they have when it comes due? Profitability is measuring their income, and then how are they able to generate that income using assets, using equity, and kind of a measure of each one of those. So there's analytical ways that we can analyze the financial statements, where we look at changes in the accounts and we calculate various percentages. Those are, if you're good at Excel, Excel makes those analytical methods so much easier. Ratios is a common way, though, that investors will look at it. So they're going to calculate these ratios and then look at a change over a period of years, or compare those ratios to their competitor to see if they're doing good compared to their competitor or not. So that's our first method: comparison over time, over a period of years, or comparison between companies. Or sometimes there'll be an industry standard. You could look at the industry standard, but sometimes your company that you're looking at maybe is like an industry maker, meaning they're the biggest ones in the industry. So then it might be better to look at their next competitor, because the industry benchmark might actually be closer to their own numbers. So then getting into those analytical methods, like I said, honestly, if you're good at Excel, use that, because it makes these computations so much easier. But we'll have a horizontal analysis where you're going to go like from this year to last year. What's my change? What's my percentage of change? Vertical analysis, where you go up and down to say, like my cost of goods sold is this, divide that by my sales, what percentage of sales goes to cost of goods sold. My general administrative expenses are this, what percentage of sales goes to my general and administrative expenses. And then the common sized takes everything and expresses it as a percent. It enables you to compare companies that are not the same size. So one's maybe very big and the other one's small. It's hard to look dollars to dollars at those. So again, like I said, the horizontal analysis, we're going to look at how much of an increase there is, and then again, or a decrease, and then we'll calculate that percentage of that. So here shows you an example. So we first calculate the difference. So let's look at current assets. It increased from 533,000 to 550,000. So that's a $17,000 increase. And then you want to take the increase and divide it by last year's number, because last year's number is like your base. It's what you're kind of comparing it to. So then we're saying we increased 3.2%. And then here, again, the same thing. We're just focused on the current assets. So we calculate our change, take that change, divide it by last year's to get the percent. Then the horizontal analysis of our income statement, same mathematics. We take the change. So our sales increased 298,000, divide those by last year to get the percent. But you can see, those of you who use Excel, and again, if you're an accounting major, Excel is super, super important, because that's pretty much what we use in the industry. It'd be very easy to calculate a formula here, say that minus that gives us this, then calculate a formula here to say the this cell divided by that cell gives us a percentage, and then you just copy them down, and then you've created that whole comparative income statement in a matter of seconds versus doing it line by line. So if you use Excel, please try to use it for these because it'll save you some time. Same thing here with our statement of retained earnings. Calculate your change divided by the prior year. And then there's an example you can read through. Okay, then now you have the vertical analysis. We go up and down. So we're going to look at what was our current assets, divide that by our total assets to get a percent. And then you do that each line. So each line of your balance sheet is that line divided by your total assets to get a percent. So then notice when you get to total assets, it's 100%. And then when you get to total liabilities and equity, it's 100%. But each one of those is just being divided by our total assets. And then we do it for each year. Then you could compare the percentages from year to year to say, am I getting better or worse? So my current assets are going up. Let's go down maybe to like debt. My long-term liabilities are going down. They're a smaller percent of total assets. So then you can make some analysis. Same thing with the income statement. It is you calculate the everything by a percent of sales. So notice sales is 100%. So cost of goods sold divided by sales gives us 69.6%. And go line by line all the way down, take each one, divide it by sales. And then again, you could compare year to year. So then you can look through those examples. The common size income statement is just only showing you the percentages. So the math is still the same. We just aren't looking at dollars and cents. We're just replacing those dollars and cents only with the percent. So then we can compare two companies that would maybe not be comparable in dollar amounts. Okay, then we have our ratios. So our liquidity ratios, we have our working capital, our current ratio or quick ratio. Then when we go over to accounts receivable, we've got our accounts receivable turnover, our number of days sales in receivables, and then over to inventory, very similar, inventory turnover and the number of days sales in inventory. So this is what, again, we're looking at. We're going to look at all of those. So our working capitals, again, what I feel like you guys really need to know in these ones is the formulas. So if I were you, I'd take like a notebook, sheet of paper, write all these formulas down. So when you're working on your quiz or your test and this comes up, you've got like a little cheat sheet to look right at what those formulas are. So our working capital is our current assets minus our current liabilities. And obviously you want those to be higher. You want your current assets to be higher so that you can actually pay your debt when it comes due. Then our current ratio is those same accounts, but just in a little bit different way presentation wise. Current assets divided by current liabilities, and that you want it to be 1 or higher than 1. The higher, the better. The higher, the more cushion you have. So again, that shows you kind of how that's calculated. Okay, hold on real quick. Okay, my apologies. Okay, then the quick ratio, still looking at those same accounts, but now we're going to basically take inventory and prepaids out of them because inventory and prepaids will not convert to cash quickly. So we look at our cash, any short-term, temporary type investments that we can quickly convert into cash, and then accounts receivable, where they should be paying us quickly in the next 30 days. So those are our quick assets, and then we'll divide those by our current liabilities. And then you can see that sometimes those ones can go below 1, and it's still okay, again, assuming that would be okay in that industry. Because again, every industry is a little bit different. So there's an example again you can look over. Then our accounts receivable, we've got our accounts receivable turnover, which is our sales divided by our average accounts receivable. And then here is it worked out. So you'll see that we've got like how many times it turns over. So this would be 12.7 times, 9.2 times. The more it turns over, the better, means you're collecting your cash quicker. This one I like better because it gives it to you in a number of days. So then you take your average accounts receivable divided by your average daily sales, and then you will take that and so your average accounts receivable divided by your average daily sales, and then you'll get it in number of days. So like here they show each one of them. So this is your average accounts receivable, which again would be your beginning and your ending divided by 2. Then your average daily sales is your sales divided by 365. Then you take your average divided by that average daily sales to get your number of days. So then that makes it a little bit more meaningful to say, okay, it's taking me 28 days to collect on my accounts receivable. It's taking me 39 days. So obviously this company's having some more issues than the other company. So I think when you put it in days, it makes it a little bit more meaningful. And again, you can look through those examples. Then we do basically the same thing in inventory. We first calculate our inventory turnover, which is our cost of merchandise sold, or our cost of goods sold, divided by the average merchandise inventory. So again, beginning plus ending divided by 2. So here they show us that. So beginning plus ending divided by 2 gives us our average. Our cost of goods sold is the 1,043,000. Divide that by our average inventory. We get it how often we turn it over. The more times, the better. But again, I like to see this second one almost more than the times, because this puts it into days. So then our average merchandise inventory divided by our average daily cost of goods sold. So our average inventory, again, is that beginning plus the ending divided by 2. Now we take our cost of goods sold divided by 365 to get an average, and then divide those two. So then now it's saying, okay, 95 days or 132 days. So obviously this company is, or I guess it's the same company, the prior year is far worse. We want it to be in our inventory as least as possible. So again, that's why companies use like that just in time. They want to try to keep inventory as low as possible and just get it in right as it's getting to be sold. I'll let you look over those examples. Then our solvency ratios are more like our debt ratios. So we have our ratio of our fixed asset to long-term liabilities, our ratio of liabilities to stockholders' equity, and then our times interest earned. So our ratio to long-term liabilities, we've got our fixed assets divided by our long-term liabilities. So then again, the higher the number, the means the less in debt we are, like the more equity we have in those assets. So if it's a lower number, they're more leveraged. If it's a higher number, they're less leveraged. Then our liabilities to stockholders' equity. So again, the higher the number would mean the more leveraged they are, the more debt that they're using. So the lower the number means they're using a little more. It's a little, there's more of a difference between our liabilities and our equity. So again, we're using a little less liabilities to finance projects and a little more equity to finance those projects. So the lower the number, I guess, the more conservative the company. The higher the number, the little more risky the company. And I'll let you look at those examples on your own. Times interest earned is our income before income tax and before interest expense. So sometimes that can be called our operating income, because that's kind of what it really is. It depends on the textbook. And then we'll divide that by our interest expense. So our income before income tax, add back that interest expense, that gives us our amount. Divide that by our interest expense, and it says how many times can I pay the interest out of that operating income. So the higher the better, the higher the more cushion. Then we have a variety of profitability ratios: asset turnover, return on assets, return on equity, return on common stockholders' equity, earnings per share, price to earnings ratio, dividend per share, and dividend yield. So what you really want to know is these formulas. So our asset turnover is our sales divided by our average total asset. So remember, when it's average, it's always the beginning balance plus the ending balance divided by 2. And this also depends on the industry. Obviously, the higher the better, means our assets are generating sales for us. But there are some industries that are very heavily asset driven. So say you're a tire manufacturer, and you've got, plant facilities all over, versus the Dollar General. You know what I mean? The Dollar General has very little in their assets. So if you're a very asset ridden or asset heavy company, these are going to be lower asset numbers than, say, the Dollar General or something like that. Then the return on assets, we're still dividing it by our average total assets, but instead of using our sales, we're using our income. And again, it's really that operating income. So it's our income plus our interest expense. So then we add those together and then divide those by our average total assets. So that's a return on our assets. Then we have return on stockholders' equity. So net income divided by our average stockholders' equity. And again, it's the average. So the beginning plus the ending divided by 2. Divide that into our net income, and that will give us a return. Now, again, all of these profitability ones, the higher the better. Then we have our return on stockholders' equity. Now this one, because we're focused on common stock, we've got to subtract out those preferred dividends and then just divide it by the average common stockholders' equity. So if there was preferred stock in there, we would not include it. So here again, they show you, but it is still the average, the beginning plus the ending. Divide that by 2 to get to the average, and then divide that into your net income less the preferred stock dividends, because again, the preferred stockholders need to get paid first. Then our earnings per share is our net income. Again, subtracted the preferred dividends, divided by our common shares outstanding. So that's our earnings per share on our common stock. So we calculate the income, subtract out those preferred dividends, divide that by our number of common shares outstanding to get to that number. Sometimes that number will actually appear right on the face of the income statement for a publicly traded company. Then these last couple are what I call more of the market ratios, because then you're looking at the market price per share of common stock and then dividing it by the earnings per share. So we just had the formula for earnings per share. Now we're going to divide that into the market price, and then we get a number. So the price to earnings ratio. The higher the number, it means that the market has more faith in that company. They think good things are going to happen. So they're willing to pay more because they have a more optimistic future. And I'll let you look through those. Our dividends per share are the dividends that are paid out divided by the common stock outstanding. So if those are dollar amounts, I mean, sometimes it is stated in a per share amount, but if it's not, we would take the dividends that they pay divided by the shares of common stock outstanding to get to what that amount is. And then I guess this is just trying to show you that just because we calculated the earnings per share doesn't mean they pay that out in dividends. They pay a piece of it out. They really won't pay it all out. And then our dividend yield is what are we getting per share compared to the market price per share. So again, if it's, you paid $41 and you got 80 cents a share, you're earning a 2% return each year as long as they're paying those dividends, or I guess at least for that year. So then this is a nice little summary page where you've got all of your formulas on there. And then here again, all of your formulas on there, and then all your formulas there. So even if you printed those 3 pages out, you'd have a nice little summary of what you need to compute those. And then companies prepare their 10K, their annual reports, And there's all kinds of information. You could always Google a 10K, maybe of your favorite company, and just look at them, but they can be hundreds of pages. You know what I mean? They could be like over 100 pages long. So it's good to look at those and understand what goes into those. So here it's showing you some examples of what is in there. So they are going to explain any significant changes. They're going to discuss their accounting policies. They're going to discuss any risks that they're facing. If there's any off balance sheet things that you're not going to see as you look through those financial statements, all of those need to be discussed. We also have to discuss our internal controls. If you're a publicly traded company, those internal controls are going to be audited. So you want to understand and clarify that, again, it's the management's responsibility to establish those and maintain those. But then the auditors will double check them to make sure that they're being followed. Then finally, again, the auditor will actually prepare an opinion to say that these financial statements present fairly the financial position of the company, and that would be what we want is an unmodified opinion. That means it's a clean report, it's a good report. If there's anything other than that, that would be bad. The company would have to, investors would really have to figure out what's going on with that company before they would invest in it. If there was any unusual items on the income statement, those should be discussed, and so that, again, the investors can understand what happened. Discontinued operations would be a good example of that, and they would explain why. And again, those are, if when we're preparing our income statement, those are kind of highlighted in there. Like if we look down at the bottom, it shows us, so they're not buried in the income statement where investors can't find them. They're out there and you can see them. And then again, they'll explain how that impacted their earnings per share number. Again, just to get those unusual items out. There can be errors. So obviously errors would be a kind of a bad signal too. If there was a major enough error that they had to restate their financial statements or discuss it. We can also change our accounting methods from one to another, but those have to be noted, and a lot of times they have to be shown, well, what does that do dollar-wise to our statements? Okay, so that is that chapter.